Welcome to VanEck's quarterly moat investing webinar. I'm Brandon Rekshosky with VanEck. We're excited to kick off 2026 with some exciting momentum behind our moat, our Morningstar moat powered investment suite, and also talk about some compelling opportunities for investors as we move into what many market pundits expect to be a new phase of the cycle for equity markets. Much of the last 2 years was fueled by concentration. Concentrated forces that were driving U.S. market returns, making it very difficult to find compelling opportunities outside of the Mag 7 and other AI-fueled themes. But as periods like the fourth quarter of last year put on full display, there is incredible value in differentiating portfolio exposures in attractively priced, high-quality companies in particular. That is a key feature of our moat investing strategies, diversifying away from mega cap tech companies that have been wagging the dog for the better part of the past 2 years. I'm joined today by a great group of Morningstar equity research veterans. Andrew Lane is the Director of Equity Research, supporting Morningstar's indexes that leverage his team's research. Aaron Lash leads Morningstar's consumer research team. Nick Owens leads aerospace and defense companies on the industrials team. And finally, Karen Anderson heads up Morningstar's healthcare sector team. It's wonderful. I'm thrilled to have such an experienced and really high conviction crew with us today. The bulk of today's webinar will focus on the performance and exposures of two of Morningstar's flagship indexes, the Morningstar Wide Moat Focus Index and the Morningstar US Small Mid Cap Focus Index. Both are focused on attractively priced U.S. companies with durable competitive advantages. The former focused on large and mid-cap primarily, and the latter being focused on the small and mid-cap space in the U.S. equity markets. Both indexes are also underlying several of our VanEck strategies. First, the Morningstar Wide Moat Focus Index is used by our U.S.-listed moat ETF under the ticker MOAT and its sister mutual fund offering. And the small mid-cap focus index, which we'll talk about, underlies our US-listed SMOAT ETF, ticker SMOT. Andrew Lane will walk us through recent and long-term performance trends of both indexes, as well as some of the compelling positioning offered in today's market environment. And then Aaron, Nick, and Karen have joined us to share some compelling insights for some of the highest conviction sectors within the flagship Morningstar Wide Moat Focus Index. That's consumer defensive, industrials, and healthcare today. So all of which of those sectors feature a pretty notable overweight relative to the broad market as a result of both this combination of high quality exposure targeting wide moats, but also very importantly, valuation opportunities relative to where their teams have pegged fair value for many of the stocks within those sectors. So Andrew, let me turn it over to you to walk through the index's performance dynamics and positioning.
Sounds great. Thanks, Brandon, and thanks everyone in the audience for joining us today. Really appreciate your time. So the Morningstar Wide Moat Focus Index has established a nearly 19-year live track record at this point since its live inception all the way back in February of 2007. And as you can see on the slide, it's outperformed the broader U.S. equity market over the last 10 years and since inception, right, over these long-term period. However, we've observed pretty significant underperformance since the beginning of the 2024 calendar year, and this has weighed on near-term performance periods. And really, that underperformance has been driven primarily by the strategy's equal weighting mechanism amid the utter dominance of the Magnificent Seven across the broad market. So let's zoom into more recent results in the fourth quarter. And here, the Morningstar Wide Moat Focus Index soundly outperformed the broader U.S. equity market, with both sector positioning and stock selection within sectors contributing to excess returns. And what's interesting is that despite the outperformance, the index's equal weighting scheme was still actually a headwind in the quarter, as the Magnificent Seven stocks combined to account for about nearly half of the total returns of this index's benchmark, which is a roughly 1,200 stock benchmark, the Morningstar U.S. market index benchmark. So despite continued headwinds from the equal weighting methodology, really strong stock selection was able to shine and drive excess returns. With regard to sector weightings in the fourth quarter, the index benefited materially from a significant overweight position in the healthcare sector, which was the best performing sector across the market overall. And meanwhile, being overweight the consumer defensive sector and underweight the communications sector provided a modest headwind to performance. Stock selection within sectors provided an even more substantial boost to excess returns than sector positioning. And impressively, stock selection was actually favorable across every single sector except consumer cyclical, which was really actually a wash. The impact was an immaterial -2 basis points. So really strong stock selection across the board. I'd also highlight that stock selection was favorable across the technology and industrial sectors in particular, and those two sectors, the stock selection combined to provide about a 160 basis point boost to excess returns. So we're pleased with those results from the quarter. For individual positions, being overweight Teradyne, Applied Materials, and Merck provided the largest boost to active returns, while being underweight Alphabet, overweight Clorox, and then not owning Eli Lilly each provided a notable drag on relative performance in the quarter. We're encouraged to see the index getting off to a strong start through the first couple weeks of January, once again, relative to the benchmark, and we hope to maintain that momentum going forward. On the next slide, this really reflects what took place during the index's most recent reconstitution, which took place on December 19th. And I'll use this opportunity to remind everyone that the Morningstar Wide Moat Focus Index is reconstituted and rebalanced on a quarterly basis. So in other words, each quarter, the Morningstar Wide Moat Focus Index's portfolio construction rules kick in, and through an entirely rules-based process, the most undervalued U.S. wide moat rated companies are prioritized for inclusion in the index. So as you can see here on the slide, valuation considerations tend to drive the vast majority of the turnover, as overvalued stocks, or fairly valued stocks in many cases, are cycled out of the index in favor of more undervalued opportunities. So those are designated on the slide as P to FV, or P divided by FV, meaning price to fair value ratio. The index removed and replaced 16 stocks in the sub-portfolio that was reconstituted in December. This is a fairly high degree of turnover relative to what we normally see. But I would, again, characterize it as good turnover, right? It's mostly turnover where stocks have performed quite well. They drove favorable stock selection and then are cycled out in favor of better opportunities. If we take a closer look at the texture of this reconstitution, the index materially reduced its overweight position in healthcare, although that, of course, does remain an overweight sector, but it also added to its tech, consumer cyclical, and consumer staples exposures. From a style perspective, the index continues to exhibit a mild bias towards value at the expense of growth, although this reconstitution moved it a bit back towards that core positioning relative to value. And as for its prevailing size, the index continues to sit sort of right on the border between large cap and mid cap, although historically, this really does chart as a large cap strategy more often than not. As it pertains to individual holdings, 13 of the 16 outgoing stocks were removed due to valuation considerations, with each of them appreciating up towards our fair value estimate, as I mentioned earlier. I'd note that Market Access was removed due to a liquidity screen, as its market cap fell below the acceptable threshold, while International Flavors and Fragrances and Pfizer were both removed because their economic moat rating had been downgraded from wide moat to narrow moat, and so therefore were no longer eligible. Let's pivot on the next slide to the Morningstar US Small Mid-Cap Moat Focus Index. And given that we continue to see a lot of attractive valuations in the small and mid-cap space, we've been seeing a lot of interest in this particular index, and I'd like to highlight that index here just for a moment. As I always like to say, the mid-cap Moat Focus Index has the same DNA as the Morningstar Wide Moat Focus Index, but just targets a different portion of the market cap spectrum. Of course, just like the Wide Moat Focus Index, it's looking for companies with economic moats, trading at attractive valuations. So while this index doesn't have the very lengthy track record of the Morningstar Wide Moat Focus Index, it still performed reasonably well versus comparable benchmarks since going live in July of 2022. As a mid-cap index, it's no surprise that its performance sits somewhere between that of the S&P Mid-Cap 400 Index and that of the S&P Small Cap 600 Index, with all three of these performing roughly equivalently in the fourth quarter. So the best way to think about the Morningstar US Small and Mid Cap Moat Focus Index is that it provides exposure to the US small and mid cap space with a focus on companies that tend to generate more free cash flow, have higher returns on invested capital, and have stronger business models than the broader small and mid cap investment universe. So it's really a sort of a quality play on the small and mid cap US equity space. And on the next slide, the final exhibit I'd like to share reflects that the Morningstar Wide Moat Focus Index is only overweight three sectors at the time being: consumer defensive, industrials, and healthcare. Right. So this shows the relative weighting of every sector in the Wide Moat Focus Index versus its benchmark, the Morningstar US Market Index. So again, just three overweight sectors at the time being. We'd note that the index is typically underweight the technology sector, as it's difficult for the index's equal weighting scheme to match the benchmark's exposure to mega cap tech companies. So we do have a relatively moderate underweight position in technology at the time being, and again, that's fairly typical. So in today's presentation, we're excited to be joined by Aaron Lash, Nick Owens, and Karen Anderson from the Morningstar Equity Research Team to each highlight one of the three sectors for which the index is overweight. And in doing so, they'll highlight a couple key themes that help explain maybe why we see some attractive valuations in each sector, and then they'll each highlight a top pick from their given sector that is a current holding in the index. So very excited to have them join the call. And before we turn the presentation over to them, I'll send it back over to you, Brandon.
That's great, Andrew. Thanks for your perspective. I'm equally as excited to hear from Aaron, Nick, and Karen. A little different than what we've done in the past, which I think will give a little bit more perspective on kind of the sector view and the deep experience within each team within the Morningstar Equity Research Group. So the only thing I'm going to say before without holding that part of the presentation up, is submit questions. So as you hear things throughout the webinar today, if you have questions for anyone that has joined us from Morningstar, please submit it in your Q&A box or your Q&A window on your screen through your Zoom application. We'll try to answer as many questions as we can. We've already gotten a few in. So please ask questions, and that'll provide probably the most interesting discussion toward the end of the call or throughout some of the prepared remarks. So submit your questions, please. So without further ado, let's see, Aaron, I'm going to hand it over to you to talk a little bit about the consumer defensive sector and some unique trends within that sector.
Thanks, Brandon, and glad to be here with everyone today. As Brandon and Andrew have highlighted, the consumer defensive space is overweight in the Wide Moat Focus Index. It accounts for roughly 4% weighting in the Morningstar US Market Index versus a 17% weighting in the Morningstar Wide Moat Focus Index. And as you can see on the slide, the sector is largely concentrated within retail defensive as well as consumer packaged goods names. And within consumer packaged goods, that's primarily household and personal care and packaged food companies. Retail defensive names, including Walmart and Costco, have performed incredibly well over the recent past, while consumer packaged good names have been a bit more challenged. And I'm going to go into why we think that's been the case and why we have so much conviction that those names will prove advantageous and a valued investment at this point in time. Moving on to the next slide. One of the areas that's gotten a significant amount of airplay over the last handful of years is really around the inflationary environment. And what's made this current backdrop so unique is the extent to which commodity costs or inflation more broadly has impacted a number of different areas of a firm's cost structure across raw materials, across transportation and logistics, as well as labor and wages. And while firms have a number of levers over which to offset those headwinds, including raising prices, unlocking efficiencies, altering price packs, as well as reducing discretionary spending, this has been a consistent or persistent headwind for these operators. And as you can see on the chart on the left, that commodity costs continue to remain elevated. They might not be going up at the same cadence that they had been a few years back, but this is a persistent headwind and has been exacerbated more recently by concerns around tariffs. For consumer packaged good companies, though, the tariff impact has been relatively muted. More specifically, most consumer product firms have suggested that incremental tariffs are only a low single-digit percentage of their cost of goods sold, given actions that they have taken over the past few decades to really reallocate their manufacturing footprint closer to that end consumer and reduce those supply chains to more effectively keep retailers and consumers in stock of the products that they manufacture. So we don't view these headwinds as a particular challenge, given the number of levers that they have and the steps that they've taken from a capital allocation perspective to blunt the hit to margins. However, this has been even more challenged, moving on to the next slide, because of what we've seen in the consumer spending environment. Consumer spending has come under significant pressure following price increases that we've seen at the shelf, as well as in other areas of a consumer's life, against a backdrop of elevated interest rates. And there's been concerns in terms of the extent to which that could pressure and prompt consumers to trade down to lower priced private label products. As you can see in the chart on the left, however, that has historically not taken place. Private label share has held relatively consistent across the consumer product space for years. And while there have been changes in terms of specific categories or aisles within a grocery store, we attribute this that more to a lack of innovation that drives traffic to particular aisles and invites private label competition, as opposed to a shift in sentiment and preference from consumers. And so from where we sit, the degree to which consumer packaged good companies will continue to spend on innovation, as you can see on the left or on the right, will keep consumers within particular brand families. This is a notable change from the last time we had a recession back in 2008 and 2009. At that point in time, consumer product companies had concentrated their spending on innovation in the premium and super premium areas of their portfolio. Over the last handful of years, that has shifted such that innovation is being distilled to all areas of their portfolio, including the value and mass offerings within a particular category. That has blunted consumer trade down, and we've heard sentiment from a number of operators over the last several quarters that they haven't seen a mass transition out of their categories by consumers because of that consistent innovation that's taking place. And so we expect that that innovation and that marketing spending will persist as a means by which to further entrench a consumer product manufacturer standing not only with consumers, but also with their retail partners that are looking to drive traffic into their outlets. So taking a step back, what names look attractive? From where we sit, Clorox looks particularly attractive at this point in time. Not only is Clorox facing and has their share price come under pressure because of the challenges around inflation and private label, but Clorox has also had a number of different factors that have individually impacted their reported results and distorted the transparency, I guess, within their performance that has made the market reluctant to jump into shares. Obviously, Clorox benefited from the run-up in demand around the pandemic. That was quickly followed by heightened pressures around raw material inflation and supply chain disruptions that took a significant toll on their gross margins. Even as they were rebuilding gross margins, they fell victim to a cybersecurity attack that prompted them to take all of their ordering offline. But Clorox was able to rebuild inventories much quicker than they or the market anticipated because they continued to invest behind their brands and their capabilities, most recently with a rollout of an upgraded ERP system that was replacing a system that had been put in place more than 20 years ago, and thus offers significant advancements in terms of technology and automation that should enable them to make more agile decisions, have greater visibility into their supply chain, as well as into the supply and demand environment. For those reasons, we continue to believe that Clorox's portfolio of brands, which have held share despite the pressures and the volatility that they've seen, we think shares look incredibly attractive, trading at a significant discount to our fair value estimate, while also yielding a significant payment from an income stream from a dividend perspective. With that, I'd be happy to turn it back over to Brandon.
Erin, thank you so much. It's a really interesting space to follow. Clorox in particular, I think when it was added back in 2024, it might have been the first time it was added to the index, if I'm not mistaken. And seeing now, based on the graphic on screen, it's sitting at a full weighting within the Morningstar Wide Moat Focus Index, so a company that we will be following very closely. Let's shift gears now. Nick, I'm going to bring you in, and we're going to talk industrials sector, specifically aerospace and defense. I'm going to turn it over to you.
Thanks, Brandon. I'm glad to be here. So I'll give you an overview of how the industrial sector plays a role in the Wide Moat Focus Index, and then I'll zoom in on one of the stocks that we cover that's a constituent. Aerospace and defense, which I also cover, and industrial products account for roughly half of the industrial sector by market cap. As Andy mentioned earlier, the industrial sector is overweight in the index, and that's because of the valuations that we see. But it's also because these companies tend to have pretty strong franchises. The most common source of moat for industrials firms are intangible assets, which can be things like brand or the technical complexity of the products that they manufacture, as well as switching costs. Often they are kind of ingrained in their customers' product life cycle, and there's few alternatives. So on the next slide, we have broken down the industrial sector by moat rating, and you'll see that Brandon, if you don't mind advancing the slide. Thank you. If this is the sector broken down by moat rating, and it's interesting to point out that the industrial sector has the highest proportion by number of companies and by market cap of wide moat rated companies. So 60% of the U.S. industrials coverage is wide moat. And as I mentioned, those moat sources come from intangibles and switching costs. And then you'll see on this graphic, I'm about to zoom in on Masco. The way the index works is that we're buying, let's say, out of favor companies within the wide moat category. And so on the next slide, I'll talk to you a little bit about what's going on with Masco. So Masco is a company that you may not know the company name, but you know brands like Kills Primer, Behr Paint, and Hansgrohe and Delta Faucets. So the company's highly exposed to the residential housing sector, and with a particular lean into the DIY component of that sector. And so there's a few things going on that make this company out of favor right now, which is why it's in the index. So rentals are more affordable than owning a house. That's been a trend for a couple of years. And I should add that one stat about what drives demand for things like paint and faucets is most people paint their house before they're going to sell it or when they bought it. And so when the transactions are low, that impinges volumes for companies like Masco. What we see in the market basically is that these companies related to housing are out of favor, are Morningstar US coverage list far outperformed the housing-related stocks, as you see on the top right chart. And again, the repair and remodel, which is really this use case of when people are getting ready to sell or have just bought a house, spending has been muted. And it was also boosted during the pandemic as people were sprucing up their environment while they stayed home. So the volumes have been muted, and that has been punishing stocks in this sector, including Masco. And you see also in consumer sentiment that the appetite, let's say, for moving or sprucing up a house has also been muted. And so diving into Masco itself, it also was hit by some tariff concerns earlier in 2025 and is one of the cheapest stocks on our coverage list. And that is why it is in the index right now. Basically, what we're saying is that this too shall pass. And when investors see a prospect for increased volumes for paint and faucet sales, the stock should recuperate as it has done in the past. Over to you, Brandon.
All right, Nick, thank you so much. Great perspective. We're going to move right along and pull Karen in now, talk healthcare. Karen, I'll turn it to you.
Great. Thank you, Brandon. Yeah, so turning back to a tree map here for healthcare, the U.S. healthcare market. Overall, you can tell, looking at the larger gray box, drug manufacturers general, as well as the top right blue box, biotech. If you add those two together, you're talking about roughly 60% of the sector's market cap for U.S. healthcare coming from these branded drug manufacturers. Thinking about this kind of from more of a moat perspective, this is among the most innovative parts of the healthcare market. I think, when you look at ROICs, that's generally reflected in a lot of these names, and we have a lot of wide moat big pharma names, and some of which are currently part of the moat ETF. A lot of those moats are generally based on intangible assets. So these companies have portfolios of branded drugs with patent expirations at varying times in the future. Of course, longer patent protection is better. Also, varying levels of innovation in the pipeline. But a lot of these companies are big enough and innovative enough that they're able to kind of keep those ROICs well ahead of cost of capital. So right now, as I think was mentioned, healthcare is overweight in the moat ETF, 19% weighting. So thinking a little bit more too about kind of what's been happening in 2025, it was a little bit of a volatile year, as it was for many sectors in terms of policy issues affecting a lot of industries within healthcare, a lot of pressure earlier in the year, especially on that pharma portion of the market when it comes to fears about policy changes relating to not only tariffs, but also pricing pressure for a lot of different channels within the U.S. drug market. So here, I'm not going to go into details, but here I just wanted to give you a pie chart kind of showing you how, thinking about the U.S. pharma market, where those sales really come from. So in the purple pieces of the pie, generally a retail market, these are the drugs that are obtained through pharmacies. The gold portion, non-retail, these are usually drugs that are infused or injected at a doctor's office or in a hospital. And then within that too, you have to think about who's actually paying for the drug. You have private payers through employers. Typically, you have Medicare for elderly Americans, and then you have Medicaid for lower income Americans. Those are kind of the bigger pieces here. And I'd say, on the left side, I kind of spell out the three things that have really changed for the better. Really starting in the fourth quarter, we started to see a lot more, I guess, appreciation of some stability when it comes to policy risks. So I'll just run through those three really quickly. First of all, the Inflation Reduction Act, 2026 is the first year that we're seeing negotiation for Medicare drugs, the first 10 drugs, part of the Inflation Reduction Act that were chosen. the discounts that those drugs are seeing relative to net prices are actually fairly manageable. And the other thing to point out too is the drugs that are selected are drugs that tend to be older, tend to be near or even in some cases at or past patent expiration. So the impact of this on our valuations has been pretty muted. The second thing that's probably the biggest factor in stock performance in the fourth quarter is the most favored nation deals that we have seen rolling out over the past few months. It was kind of kicked off with Pfizer, September 30th, the first deal, and I think the terms here have been largely consistent company to company ever since. Big picture, basically they were able to negotiate lower Medicaid pricing. So this is more of a most favored nation pricing, more similar to international markets. In exchange for being able to having a reprieve from tariffs for 3 years, as well as very likely not exposed to any future Medicare pricing policies, which I think is very key if you look at this pie. Medicaid is a relatively small portion, typically for branded drugs, it's usually less than 10% of US sales, where Medicare is much larger portion. If you add up Part D and Part B, 20 or 30% of the market. So being able to avoid that risk, I think the market kind of breathed a sigh of relief. And then the final point I'd make is the cash pay market. This is something that we don't usually talk a lot about, but 2025 was a huge year for this market, and it's mostly because of obesity. The obesity market, Lilly Direct, NovoCare, Lilly and Novo have introduced their own websites, basically allowed patients to obtain their obesity drugs at discounted prices that are similar to, or in some cases, even better than the discounts that they offer through the PBMs and through insurance companies. So that market has really taken off, particularly Lilly Direct, who was kind of first to recognize the potential of this new channel. And I think what's interesting is this channel, this cash pay channel, has it's been embraced by the Trump administration, this Trump RX website that's going into effect, allowing more and more patients who either don't have insurance coverage or have poor insurance coverage with high deductibles, allowing them to get those same kind of discounts that they might be able to get through insurance. So the nice thing about this from an investor perspective is in many cases, these discounts they're offering are not any higher than what they've given through insurance companies. So it's a way to, in a way, give a concession to the Trump administration without really offering any additional discounts through the insurance plans. So I think those three are kind of setting up a more stable policy environment for pharma right now. And then on the next slide, I'd like to highlight one of the areas, the other key piece you always have to think about other than policy risks, of course, is innovation. And it'd be hard to talk about healthcare themes for 2025 without talking a little bit more about what's going on in the GLP-1 market. This graphic, this is from our latest deep dive into potential growth of the market that we did back in November. So our latest numbers, we've got 175 billion in global GLP-1 sales by 2033. As you can see, looking at the red and the blue, we do think this will still be largely dominated by Lilly and Novo. But we're starting to see is, there are dozens of programs in development, but we're starting to see some potential for differentiation at some of the firms that are trying to enter. Probably in the 2028, 2029 timeframe is when we're really going to start to see some more pressure from these other firms. So these are things like products that are more convenient, have better tolerability profiles, could be more effective, could lead to less muscle loss, more focused fat loss. So a lot of different ways, angles that companies are going after. Of course, Lilly and Novo are also going after these as well, which is what I think makes it still a little bit uncertain how much share these companies are going to be able to get. But the ones we've highlighted here, Amgen and Roche looking to enter the market, as well as Pfizer now. Pfizer had been kind of out of the race after a couple pipeline disappointments, but now with the Metsera acquisition, actually does have a shot at differentiated products that are administered less frequently and could be more tolerable. So that's the kind of the lay of the land in GLP-1. And then maybe moving on to a company that is not really tied to GLP-1 at all, but is one of the full holdings within the pharma space and in the moat ETF, Bristol. So this is a name that I'd say, if you're thinking about kind of weighing companies based on how much exposure they have to upcoming patent expirations, Bristol is one of the names I think that's been more out of favor. You have names like AbbVie or Lilly or Gilead that tend to have protection on their biggest products through the mid 2030s. Bristol is currently going through a couple of headwinds for some of its older blood cancer products last year and this year. And then it's looking forward to 2028, some bigger patent expirations for cardiovascular drug Eliquis and a cancer drug Opdivo. So all of that kind of combined together means that about 60% of its sales base is kind of under pressure by 2028. So I think that's kind of put the company a little bit out of favor relative to its peers. That said, it is enjoying kind of a boost in the fourth quarter along with peers with the reduced policy overhang. But beyond that, I think the other thing I'd like to highlight about Bristol is that it does have a very strong pipeline. It's a little bit earlier, I'd say, than peers like Merck, for example, which I think has a very large late stage pipeline. But Bristol, there are several products here that I think have newer products with longer patent protection, as well as products in the pipeline that have significant potential. The two that I think are probably worth highlighting and worth watching the most. One would be Cobenfy. It's currently approved as a schizophrenia drug with a very new mechanism of action. It's off to a little bit of a slow start because I think doctors are a little slow to prescribe these newer types of drugs in this market. But I think doctors are having a good experience with this and becoming more and more willing to switch patients. Another key here is it's not just about the schizophrenia market. It's also in testing in a lot of kind of adjacent markets in neuroscience. So things like Alzheimer's disease psychosis, which affects 40% of patients with Alzheimer's. That's something that's going to have a lot of key trials reading out this year. So that's something to watch. And then in oncology, there's a lot of programs you could talk about, but I think one that's really interesting is a deal that they've done with a company called BioNTech, which you may remember from COVID vaccines. They actually had a very interesting new program. It's in phase 3 now, kind of seizing on the potential of two proven mechanisms of action, putting them together into a single drug. It's called pumitamig, and that could be launching by 2028. And I think that it's a very popular type of drug, and we're seeing a lot of partnerships, a lot of big pharma companies trying to get access to these drugs. And I think that Bristol is in a very good position here. If you're thinking a little bit longer term, I think this is a drug that could have multi-billion-dollar potential, more along the lines of an Opdivo replacement. So between those, the faster growing newer products, promising pipeline drugs, and then also really, significant efforts to cut costs, I think the market has been underestimating Bristol's ability to get through this patent cliff through 2028. Although I'd say with the recent run, shares are at about only at about a 15% discount to our fair value estimate. That said, it does look like the cheapest of our wide moat U.S. pharma stocks.
Okay, Karen, fantastic. Thank you so much for your perspective in the healthcare sector. Don't go anywhere because we've got some questions for you I'm going to come back to. And thank you to everyone, Aaron, Nick, Karen, and Andrew for your perspective. Please, if anyone has any questions, submit them through your Q&A window. We've already received a few that we're going to ask of our panelists today. But before we do, clearly there is a lot that goes into the rigorous research process that Morningstar's equity research team endeavors to provide to all of their clients, and that is what fuels our moat investing lineup and our moat investing suite. We've talked a lot about the first two indexes, or the first two categories: U.S. moat investing, U.S. mid-cap moat investing, but we also offer strategies across international global markets, as well as some unique dividend offering that leverages Morningstar's valuation process. So these, very accomplished and detailed individuals that are digging into the fundamentals of each and every one of these companies and assigning moat ratings and valuations are really the lifeblood behind these strategies that are implemented in a very rules-based and index way. So just wanted to make clear that this is the team that's really driving the inputs behind the underlying indexes of our strategies. Okay, all right, question and answer time. We did get quite a few questions in from the audience, so we're going to try to chip away at that. And I'm going to start with you, Karen, since you are on the mic just now speaking about healthcare. Andrew had referenced in his portion a result of the quarterly review process, which saw Pfizer removed from the flagship Morningstar Wide Moat Focus Index. And the reason it was removed is that its moat rating was downgraded several months back, and now it worked its way out of the portfolio. We received a question from Ben asking for a little bit more detail around the Pfizer removal and ultimately its moat rating downgrade. Can you touch on that?
Yeah, sure. Happy to. Yeah, we do periodically review. Of course, we're always reviewing moat ratings for the big pharma names. And it was back in July that we downgraded Pfizer to narrow. What we've done is kind of a stress test of policy risk and how it's affecting a lot of big drug manufacturers. And Pfizer is a name where returns on invested capital have generally always been kind of in a more borderline category in terms of being able to maintain that moat longer term. A lot of this was, and it was, of course, a little bit distorted. They saw massive revenues during COVID from their vaccine and their treatment Paxlovid. But now kind of coming back down to earth, they've also taken on a lot of extra invested capital after the Seagen acquisition, which was one of the biggest acquisitions they've done in recent years. So with that and just a very long list, frankly, of failed pipeline products, failed launches or disappointing launches, Pfizer is a company that we felt like we didn't quite have that same level of confidence that we did in the other names that it could withstand the kind of policy risks that we were looking at. So it remains more of a borderline situation. Other companies like Bristol, I know I had mentioned Bristol as being kind of in more of a weaker camp when it comes to upcoming patent expirations. That's one that we also looked at and looked at, potential severe price cuts for within areas like Medicare, but it was still able to maintain, even in those scenarios, Bristol was still seeing ROICs north, of course, cost of capital. So one that we have a lot more confidence in terms of the moat rating there.
Excellent. Thank you, Karen. We received two questions that really kind of get at the heart of the title of today's webinar presentation about differentiation, diversification. So I'm gonna kind of read both of them, and Andrew, I'm gonna come to you on this in terms of the implications on the index and ultimately the ETF that VanEck offers based on that index. So before the webinar, someone submitted a question interested in understanding the risks of market concentration in today's market. Most of their assets are tied to the S&P 500. And then Ryan also pointed out a trend that you touched on as well, Andrew, with more of the Mag 7 has come back into moat, particularly in the fourth quarter, where Meta, NVIDIA were added. Microsoft saw its weighting increased. So Ryan has some concern about all of the tech and AI related names that have seen such dramatic increases in the fair value assessment aside, not the price, but the actual fair value assessment assigned to those companies. So with many of the wide moats in the eligible universe being tech related and based on valuations kind of changing and going up along with prices, could we see some correction in some of the names that have since been added after some run up? So a lot to unpack in those questions, but maybe you can talk a little bit about structural exposures that you're expecting to see from the index methodology, along with evolution of some of your tech analyst team's views on valuations.
Yeah, absolutely. So great questions. Let's talk about diversification in a broader sense first. So, sometimes when we see certain stocks going in and coming out of the index, you start to get a sense that, the role this index can play in a portfolio is changing quite a bit. In reality, as an equal weighted strategy, this is an index that really is a fantastic complement to like a traditional core market cap weighted index like the S&P 500. Typically, whatever direction the S&P starts to lean, right, in terms of value growth, this index typically moves in the opposite direction, right? So it typically sort of capitalizes on the more unloved corners of the market, whereas, of course, as a cap weighted index, the S&P is leaning into whatever has been working or sort of what pockets of the market have been performing well. So in terms of the fourth quarter reconstitution, we did see a couple Mag 7 stocks come in. NVIDIA was added for the first time in a few years. Meta Platforms was added as well. And then Microsoft was increased to a full weighting effectively. At the same time, we did see Alphabet reduced. So Alphabet, because of the fair value screen, price to fair value was reduced a bit. So we did slightly increase our exposure to the Magnificent Seven, but even after this change, the Morningstar Wide Mode Focus Index is still substantially underweight that basket of stocks. And it's important to sort of take a step back and recognize that even if we owned all 7 of these stocks, because of the equal weighting methodology, we'd probably only have half of the weighting that they have in the S&P 500 or in the Morningstar US Market Index benchmark. That's just a byproduct, again, of the equal weighting scheme that we use. So I would say this was a very slight increase in the grand scheme of things towards the Mag 7. But it's important to also contextualize this in the sense that this isn't sort of reflective of chasing performance. The stocks that came out actually had a pretty big the stocks that were added, the Mag 7 stocks that were added, had a pretty big pullback in the fourth quarter, and we're capitalizing on what we think is perhaps an overreaction for stocks that I think are going to continue to perform quite well in the coming years. And in the case of Alphabet, it was sort of the shining star of the AI trade in the fourth quarter, had a fantastic quarter, and of course that's the one that then gets removed. So there continues to be this sort of contrarian element rather than a trend following element, despite seeing some of these Mag 7 stocks come into to the strategy.
I'll tack on just maybe one or two things. It gets a little bit more to the first question, just about concentration in general. And I think that's a narrative that any industry professional has been hearing for some time. Concentrated in markets, lack of market breadth. The market being driven higher by 10 names or so, and that's been persistent over the last 2 years. If you're not a market professional and you're just monitoring the markets, maybe you're not as aware, but you think about things like the Magnificent Seven, which gets a lot of playtime in media. These 7 companies, you can add a couple other names that are very much tied to the AI theme. That represents over a third of the exposure in the S&P 500, which tends to be one of the most widely owned indexes in the market. Moat's index currently is just under 6% to those names, and it's only 3 names, I think. No, 4 names, sorry. And so acknowledging concentration. Now, that concentration has been very good for investors in the S&P 500 for the better of the last 10 years, but more specifically in 2023 and 2024, the market cap weighted S&P 500 outperformed an equally weighted version of the S&P 500 by more than 10% both years. That hasn't happened in quite a bit of time. And through December, if you look at the S&P 500 market cap weighted index, again, over 1/3 Magnificent Seven exposure, relative to the equally weighted version of the S&P 500 through December, On a 3-year annualized basis, this market cap weighted index has outperformed the equally weighted index the most it ever has at year end on a 3-year basis by 34% annualized over 3 years, which is very significant. The last time that's happened and nearly in that scale was around the dot-com bubble, when that peak excess return of market cap names was around 32%. So we're in exceptional times, and the markets started the year kind of continuing to go up. Today's probably an exception, but it's great when these broad-based indexes go up, and a few names are performing really well, but oftentimes the wind can come out pretty quickly. So diversification really can be key. Okay, I'm going to ask maybe a few quick questions that came in, and I'll bucket these under uncertainty and how that impacts the Morningstar equity research process. So maybe we can hit on a few of these with some of you. So maybe I'll start with Karen and then go over to Nick. And a lot of this has to do with current administration policy. So Trump gets a lot of headlines. Everyone knows that, but he's saying things regularly that have real world implications and could notably impact many of the companies that you all cover. So Donald asked generally how your team thinks about Trump's healthcare policies, particularly his kind of adversarial approach toward the legacy Obamacare funding and subsidies, as well as, I guess you could bucket, drug pricing pressure into this conversation. So Karen, why don't you take that one? And then as soon as you wrap up, Nick, a lot of news around your coverage, which is aerospace and defense, and how defense companies are getting pressure with their dividends and buyback strategies. And then also, you see headlines about how Trump wants to increase the national defense budget by 50% as well. And that's all hard probably to model. So Karen, maybe you can take it and kind of first and talk about these uncertainties and how they factor into your day-to-day.
Yeah, I'd say, looking back, I guess kind of pre-Trump, we have been thinking about U.S. drug pricing as a risk. It's been standing out there for a while as an area where pricing is significantly higher than other developed markets. So that's something where in the past we've put out reports kind of talking about what these drugs are worth. We've looked at cost effectiveness research, and we actually did end up increasing uncertainty ratings for some names where we felt that the drugs were not worth anywhere near what the current pricing was at, which to us added a substantial risk that price could fall. So that's something just kind of long term. We have been looking at pricing as a risk. I'd say the most recent, if I'm just thinking very broadly on healthcare and kind of what's been happening with like the one big beautiful bill and some of Trump's actions related to healthcare there, probably the one that the uncertainty rating tool has been most useful for has maybe it's not a moat ETF category, but the healthcare payers, the managed care organizations. That's where our analyst Julie Utterback, she's talked a lot about not only have these companies been through a lot of issues with mispricing their plans, seeing higher medical utilization, but they're having now to work through expiration of these subsidies on the exchanges in 2026, and then I think it's 2027 that the one big beautiful bill work requirements for Medicaid are going to start to hit Medicaid enrollment. So that piled on with other scrutiny on transparency at their PBMs that are often in-house at the payers. I think there was just a headline this week too. Julie put out a note on United Health about Medicare Advantage plans and kind of looking at how those are reimbursed and the government looking there. Through all of this, Julie has she's basically ratcheted up uncertainty ratings in this group. So we have several names like United Health now at high uncertainty. Some of the names are at very high uncertainty if they have a lot of exposure to areas like Medicaid. So that's one tool, one way that we have handled it. Doing that, but also recognizing the fact that beyond kind of these near-term concerns, she does see a return to better growth in the very long term forecast. I'd say, we haven't made, just recently, we haven't made as many changes in the drug space on uncertainty. Just if you think more specifically about cuts to Medicaid and exchanges, these are smaller parts of the market, and Medicaid is the lowest price segment. So as I mentioned, it's usually sort of a single digit portion of sales, or of US sales, and even a smaller portion of global sales at these companies. So that hasn't been a lever that we felt we had to pull, but it's definitely there when we see bigger pricing issues.
Nick, over to you. Maybe any like visible implications, or is it really just kind of fodder and uncertainty around like the dividend and share buyback suspensions that Trump wants to impose his will upon? Oh, you're on Nick, or you're on mute, Nick. Sorry.
Thanks. The short answer to the question is we certainly live in interesting times related to this defense sector. Broadly, and this kind of played out throughout most of last year, you did see some more pointed dialogue and kind of public airing of budget concerns or budget questions, and now you have a proposal to increase defense spending quite sharply. What I would say is that we have not changed our uncertainty ratings around these companies as a result of that, because actually the idea that the federal government is the primary buyer of the products for these defense contractors is not news. It's really just a matter of what is the kind of policy priority or the nature of the dialogue. Last week, you had a specific kind of 1-2 punch around this dividend policy question, and then a proposal to sharply increase defense spending. What I'll say about the dividend and buyback policy is that it was accompanied with a full text executive order. It is specifically conditioned around if a company is determined by the defense secretary to be behind in delivering their promised products. That is when they could impose a restriction on dividend or buyback payouts. So it's really more of a kind of a carrot and stick approach to basically, I don't know what else to say other than, let's say, corral defense contractors into prioritizing the products that the Pentagon wants to procure. So, yesterday, L3Harris commented that they're not behind on their stuff, so they don't think it applies to them. So I think that is probably going to be the norm, unless a company comes into particular, let's say, arrears delivering on their products.
Okay, great. Thank you. Appreciate that from both of you. We do have a few more questions. We're very conscious of time and don't want to steal any from our attendees, but I think we can nail these, bang these out real quick. So let's start with a very general question, and Andrew, you can probably take this. Coming in, very similar questions from both David and Alexis. How do you compute your fair value for stocks?
Yeah, absolutely, and certainly, I could spend a lot of time on this getting into the details, and always I'm happy to do so with clients and prospects, but with limited time now, we use a 3-stage discounted cash flow model. So stage 1 is an explicit forecasting of the various financial statements. Stage 2 is a period that captures whether or not the company has an economic moat, and if it does, that holds free cash flow higher for longer because of the competitive advantage at play. And then stage 3 is the phase where eventually every economic moat is diluted and fades away. And so in stage 3, returns newly invested capital are set equal to our cost of capital, and free cash flow fades back down over the long run. So we forecast through those 3 stages free cash flow of the firm many years forward and discount that all back to the present day. So unlike a price target that you'd often hear about, our fair value estimate is what we think the company is worth today. It's all the free cash flow discounted back to today. That's where we think the stock should be. And then there's one other question here from Ken I can address quickly. He asked if there are plans to adjust the portfolio construction rules. The last time we made a major change was in June of 2016. The short answer to that is no, we have no immediate plans to make any significant changes to the portfolio construction rules. I think we're very happy with how the methodology works at the time being. And he also asked about whether it was beneficial to change those rules in 2016. I actually did a little study on that last year. So as of a little less than a year ago, that methodology change in 2016 slightly increased annual return from that period to again about a year ago, but it materially reduced risk. So the Sharpe ratio went to 0.72 rather than 0.65, which is what it would have been under the old methodology. And that's actually a pretty massive improvement. So long story short, we really only make changes to the portfolio construction rules if we think that they're very much warranted and will significantly improve the experience of anyone invested. And the 2016 change did just that, but no plans to make any changes anytime soon.
Excellent. Thanks, Andrew. One last question. I'll take this one from Ben. When I was showing some of the products offered by VanEck on Morningstar's indexes, he noted that the moat, M-O-A-T, the kind of flagship offering, and then we have a value-oriented wide moat product under the ticker MVAL, MVAL. What are the differences in additional screens? Really simply put, there's a style tilting methodology in which value-oriented, attractively priced U.S. wide moat companies are given favored weighting within the portfolio. So you get a predominantly kind of typically large value exposure from that particular offering. It's a newer ETF, but it's all been constructed based on the very long-standing equity research offered by those that are joining us today and 100 other colleagues globally. So thanks for that question, Ben. This has been wonderful. I didn't know that we'd fill the full hour, but we got a lot of questions. We got a lot of good perspective. We didn't hear from Erin in the Q&A, but she was busy typing answers directly to some of the attendees. So thanks for everybody for joining and taking time out of your day to hear from our folks over at Morningstar. Very much appreciate your time, Erin, Andrew, Karen, Nick. We very much appreciate it. And with that being said, until next quarter, please check vaneck.com /subscribe. You can get tons of great content from Morningstar's professionals. And we'll see you all again in about 3 months. Thanks, everyone.